Get started. Good morning, everybody. I'm Stacy Fagan, Vice President for Philanthropy at the Vermont Community Foundation, and welcome to our Q3 public investment call, which is for open to the public, of course, but it is also for our fund holders to have an insider view of our investment performance. We welcome this morning Mike Miller, who is founder and CIO of Crucial Partners. And of course, Crucial has been our longtime investment partner with the foundation. And through our partnership with Crucial, we have access to world-class investment management and an organization that values the long-term sustainable growth that is important to our fund holders in our mission. We're also welcoming Lawrence Miller, who is our Senior Advisor for Mission Investments and who oversees the Vermont investment portfolio. He is the former Secretary of the Agency of Commerce and Community Development for the state of Vermont and consultant and former CEO for Danforth Pewter, among many other things in his repertoire. So welcome, Mike and Lawrence. We are also joined on the call today by our chair of the VCF Investment Committee, Tim Briglin, Rod Buck, who is on our investment committee as well. There may be others who I can't see right off on the first gallery. So if you are joining on the call from the Vermont Investment Committee, please chime in and say hello. Our board chair is also on the phone, Mark Foley. And we are joined by many staff, including our VP for Finance, Barry Pius, our philanthropic advising team, Martha Trombley-Oakes, Elizabeth Marks, Emily Pilo Corbett, and Chelsea Lord, and our Director of Investments, Abby Meyer. There are other staff on the call, but most of them are here, the folks I just mentioned, to support the engagement of our fund holders who are most keen to get this update. And if you have follow-up questions, they'll be available to speak with you as well. I did see Dan join the call. So Dan, I want to turn it over to you, if you don't mind, and ask you to frame up the call before we turn it over to Mike Miller.
Stacey, I appreciate it. Nice to see everybody. Been a bit. Welcome to the Q3 investment call. It sounds like you took care of introducing everybody. I apologize for being a minute or two late. We're excited to share the returns and the report from the merged now Vermont core investment pool, and to hear from both Mike and Lawrence Miller on the performance of these pools. I would remind everybody, and we're in this exercise because of our commitment to Vermont communities and to philanthropy more broadly as we get into the giving season. Encourage you all to reach out to your philanthropic advisors, a number of who are on the call, to think about your year-end giving and planning in advance of some of the tax policy changes that will go into effect for next year. So encourage you to touch base with the team as we get into the holiday and the giving season. I'll turn it over to Mike for the report on the pool. It's nice to see you, Mike.
Great. Good to see you too, Dan. Welcome back. And so let me start with I was thinking about Stacy and Dan's introduction. They talked about sustainability of impact. They talked about philanthropy. And our job, as you know, on the investment side is to deliver the returns that support that. I'm actually just about to celebrate next year my 40th anniversary with Crucial. And what I wanted to say is that I can't think of another time which was as frightening as the one we're in right now. And I'm not even talking about some of the things that might frighten everyone on this call around geopolitics and economic conditions, all those things. But we have a massive, and this is going to sound like a negative, but it's going to sound like a positive, but it's not really a negative. We have a massive technology boom occurring right now. It's a new technology, AI, of course. You can't have a call without talking about AI. But the reason it's terrifying is that every technological revolution in the past has had one common characteristic, whether it be railroads, the internet, or now AI, we think, which is the massive destruction of investor wealth. And I think this is something that people don't necessarily think about as much as they need to, because these things don't happen that often. This might be the third significant technological revolution of the last 100 years or so. And so it's really interesting as an investor to think about what that means. And so some of what you're going to see about the pool and the core pool, what we're doing is, in addition to thinking about implementing this a strategy that is attuned to the values of Vermont Community Foundation, all of you, but more importantly, is well, as importantly, I should say, is one that will preserve your capital no matter what happens. Because I think maybe what we're most concerned about with the markets today, and I'll show you a couple graphs to prove this later, is that is that there's way too much clarity as far as the markets are concerned for exactly how this is going to play out over the next 5 to 10 years. And I guess we just ask the question, what if? What if AI, for example, doesn't prove to be that big a deal? What if? What if NVIDIA doesn't prove to be the leading chip maker forever? What if? What if? What if? And when you have 30, 40% of your capital tied up in these businesses, and the what ifs prove to be problems, that's extremely destructive. So we need to think about how we walk that line, particularly when we're competing with a benchmark that has 30, 40% of its exposure in these names. I'll show you a couple of cool graphs in a moment to illustrate that. Let me do this first, if I can get to this to work perfectly. There we go. So here are the returns. I will tell you, if you just look at the top line, this is the core pool. So the brand new pool that we've talked about, introduced to the last call, and I know you've heard about this many times otherwise, and you can see it's doing something we don't like. It's doing something we do like, which is generating a lot of return. Actually, right now through last night, the core pool's up almost 14% year to date and rising, I'm glad to say. But it's lagging its benchmarks, and it's lagging its benchmarks because we're doing two things that the recent lag is creating some of the long-term lag. The two things it's doing that we're doing, excuse me, that are not helping right now is we are underweight some of these AI names. Now, we don't not own them, to be clear. We do own them. We just don't own 35% of our money, of your money in those names because we think it's too risky. The second thing we're doing is we have made this portfolio diversified for a reason, because it does protect on the downside. If you were with us, and I'll show you a slide in a second, 2 quarters ago, you'll see how this pool preserved capital in a very, very stressful time for the markets. We expect to do the same thing next time too, by the way. So we're giving up a little bit of upside at the moment. We feel fairly comfortable with that because we like getting, like I said, a 14% return year to date while we're being somewhat cautious. Sounds pretty good to us. We'd rather have the benchmark return, of course. And if you look out to the longer term, to 15 years since inception, we have actually outperformed the benchmark. Now, one of the things that I want to point out, 2 quick things on this return point, because we're not oblivious to the importance of beating benchmarks, though. It's what drives us. But what you can see, if you look at the bottom, so the top numbers are just per year, basically, they're annualized results. The bottom is a compounding of those returns. And one of the things you see is, for example, you look at the very far right, the 7.5% return for the pool versus 6.7 for the benchmark. It's funny to think that 7.5 is actually the lowest number on that top table. But if you look at the bottom, when we compound it out, you get to basically 447% return versus only 359% return. So the reason, the scale here, the way that returns basically get much, much larger if you compound over time, is a driving force here. And that's why you said, Stacy said our focus on the long term. We are willing to earn, for example, 53.2% over 5 years versus 56, as long as we can deliver 447 versus 359 over a very long period of time. That's a trade-off we're willing to make because it's hard to do both. It's hard to always be right because no one can do that. Now, the second thing I want to point out is that when you look at the 10-year number, 8.2, which is great because it matches CPI plus 5, so we have achieved that very significant objective, but it's not 8.8. And I want to show you now how rare it has been in the history, because that was always happening. Then, I know you guys have probably heard plenty of financial people make excuses for literally everything. And so let's not make excuses. Let's talk about whether this is a probable event or not. And so here's the next slide. So what we did here is we said, well, let's go back and look at every 5-year period, every 7-year period, every 10-year period. So pretend for a second that we met every month and I showed you a chart like the one I did before a minute ago, and you got to see the 5, 7, and 10-year comparisons. And so at the top line, the batting average is showing you is for every 100 times we met, what number of times would you see that 5-year number above the benchmark, not below it, 7 above, not below it, and the same for 10. And what's kind of interesting, as you can see, is for the 10-year period, you can look at anything when you want, but 95 out of 100 times you would have seen the benchmark being outperformed. This is since we started working with the foundation. So our view is that in baseball, what a 300 average is great. In any kind of game of chance, a 500 average means you've got no skill. A 950% average means you're pretty skillful. And the committee, and I will throw Crucial in the mix too, has been relatively skillful, over time. And so we're arguing, and I'm going to continue to argue, that what you're seeing in the last slide, where we like the absolute returns, is an oddity, and you should not expect it to continue, just to be clear. Now, the second thing you'd ask, if I were you, is when you beat a benchmark though. So let's say you have a 95% win rate, but what if you don't even beat the benchmark by that much? So why is it worth it? Just own the benchmark, which is a very valid point. So that's what the median outcome does. So it looks again, every period winning or losing over the 5, 7, and 10-year period. So again, every single one, every month, basically you can see if you look at the right, 25.8% cumulative outperformance. That's cumulative, not per year, just to be clear. That's why those numbers get bigger. So 5-year out to 10 years is going to get larger. So essentially the portfolio's average outcome was to outperform by 25 percentage points. So if you had $1,000, if you had been in the index, you'd have $1,250 basically in your account. So it's a very, very big difference. And we think it's very much worth taking the risk of underperforming to generate that much outperformance. And then the last thing we have on this slide, just to be quick about it, is also just a little bit of what does the distribution look like? Because what you don't want to do is, let's say you can outperform by 25%, but you also underperform by 40 sometimes, and you just create too much stress for the meeting that we have on that date when you've underperformed. So you need to have positive skew. And that's why you'll also see the best and the worst case outcomes. And this is another thing we're really proud of, which is that when things are good, they're really good. 42 percentage points of outperformance is the best 10-year outcome. And the worst, which we're not happy about, it's actually happening right now, is -6%. And so I think to us, that's also hopefully gives you some confidence that this is mostly a winning strategy. And when it wins a lot bigger than when it does have some disappointing outcomes. So again, we're not thrilled with any underperformances, but we take a lot of solace in this track record, and we think that frankly the new core pool makes it frankly easier for us to continue this and maybe expand upon it, which gets us to the basics here. So why does the new pool do better, or should it do better, even better than the old pools did? One is it combines passive and active. So the long-term pool in the past was very active, and the socially responsible pool was more passive. And we can't think of a better time to have a little bit of a combination of the two, with still the tilt towards active, to be clear. Fees are now lower. They're down to 57 basis points, and that's the long-term pool was considerably more expensive. So that's a simple part of the math. Everything I showed you before, which I didn't mention, but let me mention it now, is net of fees. So when the fees go down, then the performance goes up. It's not that complicated, right? And so that's obviously good. And we have a very sophisticated ESG factor analysis, which I will not spend a lot of time today, but I'll show you a couple of things, which we think also enhances the returns and mitigates risk. And again, so we're not doing the ESG simpleton screening thing. We're doing ESG in a way that looks to ferret out risk and to assess investors in a more robust way. It's probably a call onto itself someday. So let's go back to one of the things I mentioned a minute ago, which is diversification and downside protection. So this is going back to something which, people have conveniently forgotten about, which is tariffs. And when the tariff announcement and Liberation Day occurred, obviously the markets took a huge hit, which was short-lived. And it's funny because normally short-lived market reactions occur. They're short-lived, I should say, because somebody adjusts the outcome in a way that makes the market happy and kind of the temper tantrum gets satisfied. In this case, very interesting. For the most part, the temper tantrum, reasons for the temper tantrum, is what I call it that, have not been satisfied. The tariffs are here. The tariffs are absolutely doing economic damage. And so it's very interesting to think about how the market just moved on. But needless to say, we're still thinking about how the pool can preserve capital. So back at that time, so this was around the bottom, the S&P was down about 10% year to date. The so-called Magnificent Seven were down 21% year to date. And the core pool, which is mostly liquid securities, by the way, we don't have a ton of illiquid stuff in there, was down 2.5%. And that's the kind of risk mitigation that we want to see. That's, I will admit, more extreme than we expect in a normal bear market, but it was better. We're not expecting to do that quite that well. But my point is that having diversification, having downside protection is extremely valuable. As a reminder, the investment approach here, so if you're waiting for a short-term market forecast, I'm sorry to disappoint you. We don't do short-term forecasts. What we do is we think long-term. So where are the best returns, which is why the AI thing is a big deal for us, because it's not a short-term issue, it's a long-term issue. The second thing we do, as I mentioned a minute ago, we don't try to guess where the market's going to go in the short term. So that did serve, we're up 14%, I mentioned year to date. The reason we're able to recover alongside the market to some degree is that we didn't go to cash when the tariffs hit. We don't make decisions like that. We don't get super aggressive. We stick to a strategy. And I think it's really important. And the last but not least, and this is the key point, is to be diversified. And that's what's been lost in this current mega cap AI craze, is the indices have become increasingly concentrated. And concentration and risk are synonyms in the investment world. So again, everybody loves risk when it works, but when it doesn't work, it can be really painful. So diversification should be a constant, but it's increasingly hard to find in the indexes, which is disappointing. Here is the core pool's asset mix, which is, and you can see very long-term oriented, 61.5% in stocks, 12% in alternatives, and the privates are kind of coming down over time. To be clear, they'll probably become more public, and about 25% and 26%, excuse me, in bonds. So this is just established as the core pool was created. It's reviewed by the committee no less than once a year. It doesn't tend to change too quickly. It's like watching grass grow, which is what we want it to be because it's supposed to be stable. The things that would cause it to move around a lot would be massive market shifts. So if the market dropped 40% tomorrow, you might be surprised to hear that committee would likely, if that was still the case, the committee would meet. And if that was the case, then my guess is the committee would raise the equity exposure. So we like lower prices. Everybody loves high returns, but the problem with high returns is you're basically getting higher prices. So lower prices accompany bad returns. Nobody likes the bad returns, and we're included in that group, but it's a chance to own things at a cheaper price, which we do like to do. So the ESG strategy I mentioned before, I just want to touch on it quickly because I do want to spend a minute on the AI issue, a little bit more time than I normally would. One is that this is the foundation. This is not new for the foundation. The foundation is one of the prime pioneers, and Lawrence is going to talk later about the Vermont investments. That was the coolest thing ever. It still is, actually, and that was from 20 plus years ago. So the foundation has long been in this business. This is nothing new. The ESG engine is not focused on the current state. So one of the things that we're very focused on is which are the kind of companies you want to own are ones who actually are not doing anything that's dangerous for their businesses, their employees, their communities, or their shareholders. The second thing you want to do is you'd love to have companies that are actually going to benefit from the change going on in the world, or companies that, by the way, might have been somewhat badly behaved in the past but are changing. Those are the best because sometimes that's not the stock price, and it's really, really powerful. So the strategy is focused on climate crisis, equity, governance, and avoidance, as I mentioned earlier, of destructive controversies. It's done at the stock level. It's done with reports to the committee. It's done with engagement with all the investment managers. So it's a very big undertaking, which I will not talk about in great detail today, other than to show you, here's a quick list of some of the things that we're using in the Crucial model. So we buy data from a company called ISS. We don't create it ourselves, but we're very particular about what we use. We don't use everything they have. We selected like 27 variables basically that we care about. Here are some of the ones we're using. So let's talk about the world for a minute. And I want to be careful not to give investment advice. So what you do in your personal portfolios, of course, is great. It's up to you, of course. But I'll just tell you how we're thinking about the world, and you can do with that what you will. The first thing is the shift in global alignments is completely misunderstood in this country. If you go outside the United States, spend much time outside, you can feel it. The difference in attitudes is radical. I've never seen anything like it, frankly. And I've got to tell you, just to get into a really nasty area right away, the people who are happiest right now in the world probably are the Chinese. The Chinese government can't believe its good fortune, that the U.S. is just giving up advantage after advantage after advantage around biomedical research, around environmental climate change. It's really something. I was just there about a month ago. It's there. They could not be happier. This federal spending is a real serious issue. I'm going to show you something a little later about some of the challenges. So the shutdown, of course, appears to be over, but that wasn't making things better for sure. The third thing is because we have new immigration policy, the supply-demand imbalance in the labor markets is also an issue. And we wrote, is AI a lose-lose proposition? So this is one of the scarier thoughts. I'm sorry, I feel like Mr. Doom and Gloom today. One of the scarier thoughts is that, let's say AI doesn't work. So you have 30, 40 trillion dollars largely of investor capital tied up in this stuff, and some of that's just going to disappear. So that's problematic in and of itself. Or even worse, maybe, what if it does work? And then do we have, like we're starting to see with young people today, do we have a huge employment shift in the United States where there's just less jobs, a lot less jobs? And what does that do to the fabric of our society is also interesting. So it actually could be a lose-lose proposition, which is a really frightening thought. And I'm sorry to share that with you. And I will continue on. So I want to be clear. AI is not a bubble. We wrote this to be provocative. AI is a massive technological revolution that's undergoing. The problem with it isn't that it's a bubble or not a bubble. It's a normal technological revolution. It's drawing in tons of capital because without the enthusiasm, you can't have the technological revolution. It's pretty simple, right? But what we're showing you here is that you should be really careful, though, with the concentration question. So this is the way. So for those who don't think about indexes all day, the way they work is the size of a company in the index, like the S&P 500 or the All Country World Index, if you use that one, is based on the market capitalization, i.e. the value of the business. So NVIDIA has been a wonderful stock. And if you own a lot of it, awesome. Great. And what you can see there, that dark blue line at the bottom is the awesomeness of NVIDIA stock as it rises and rises and rises for the most part. And you can see it's so big as a company right now in terms of what the market's valuing at, that it's almost as large as the entire US industrial sector. That's the blue line, and the entire US healthcare sector. In fact, I believe you looked at this today. This is through the end of the quarter. It's past the industrial sector now. The healthcare sector is actually done a little bit better, so it might not have passed that. So we're essentially, the markets are saying that NVIDIA is worth more than the entire industrial sector in the United States, which could mean, it can mean one of two things. It can mean that NVIDIA is too expensive, or it could just mean that the industrials are too cheap. Pick whichever one you want. We tend to care more about the second part, which is let's go look at industrials to find cheap companies that are really good businesses, because this is kind of silly that those stocks are that cheap essentially, and that NVIDIA is worth more. Continuing on, the other worry right now is we have entered the period where speculation is really high. Some would argue that crypto is a sign of speculation. There are certainly aspects of that market that are, but I think this chart really gets to the real heart of the matter. If you look at this is the year-to-date returns. I guess this is through, I can't remember, September, excuse me. And take a look at the far left. The best performing type of stocks in the market were NASDAQ companies with no revenues. So think that there are companies literally with no, like they're usually in robotics, there might be in AI related companies or crypto related companies, but these companies, I mean, literally zero revenues. One of them, in fact, which I believe has I can't think of the name right now, it had $1 million of revenue. Back in September, its market capitalization rose to $2.5 billion. It has $1 million of revenue. Some of these companies are just out and out frauds. Some of them are just, gnashing companies that the meme stock crowd gets a hold of and drives them to the roof. But it's just amazing to think about that the leading names in this market are NASDAQ companies with no revenues. And the worst names, look at that to the very far right, are the profitable NASDAQ and the profitable small and mid cap stocks. So it's really fascinating. And this is a little scary. This is actually very scary. This stuff is always bad. And what's really a little frustrating for those of us who have to deal with indexes is these things are affecting the indices. And so there are things like the Russell 2000 and some of these other names have these NASDAQ no revenue companies in them. And so they actually have been skewed by it. It's very, very bizarre. So one of the arguments that the NASDAQ AI thing is a long way to go, which we wouldn't dispute, by the way. There is every reason to think is certainly possible. In fact, might even be probable that this is 2 or 3 more years of this. That's how long these things tend to last. So what this is doing, this chart is giving a little bit of sense of the relative perspective of the last 5-ish or so bubbles compared to the NASDAQ AI surge. So everything's a bubble after it's a bubble, of course. You can't say it's a bubble before it's a bubble. That's the key point. So the Nikkei, if you remember that back in the 80s, a massive run and then a huge collapse. The NASDAQ last time around, that one should rhyme for you. China, people forget China used to be a hot market. It was, though, at one point. Oil, and then biotech, which has been a little bit weirder, kind of came back before it collapsed again, but then it collapsed again in the 20s in our current era. So again, that's part of the argument that, hey, don't worry about it. This will be fine. Not sure I would bet my future on that, though, personally. And then last but not least on the scary stuff, and then I'm almost done, I promise. The other thing that's there's a lot of things lurking out there. One is, I'll just bring it up because you haven't heard this in a while, is DeepSeek, which if you go to China, so DeepSeek, remember, was the thing 6 months ago that tripped up some of these NVIDIA type stocks, which is that DeepSeek essentially is a Chinese AI engine, kind of competes with OpenAI or Anthropic. And essentially, according to the Chinese, is just almost as powerful and requires a fraction of the compute power. So therefore, the data centers and all the chips and all the things that are fueling this huge AI investment period we're in right now wouldn't mostly be necessary. So that's kind of go do a search or talk to US people and ask them about DeepSeek, and people don't even remember what it is anymore. It's still there though, and the Chinese are using it, by the way, and they're using it big time, and it's working. It's about 90% as effective as the most recent OpenAI model, apparently, and they're using it so powerful and it's so low on processing needs that they can use crappy Chinese chips to run it, which is really interesting because the chips are not great there. So very interesting. So that's one of the things lurking out there. The other one lurking out there is, what about the US debt? Here we are again. And this chart, I think, just does such a great job pointing out to what could go wrong here. So the dark blue is essentially the cost of debt. So what was the interest rate the US government had to pay on its deficit? So that's to the right scale, just to be clear. So the very top on the left, back in 1990, the US debt was costing about 9%. That was the interest rate. Of course, we all know, especially when the 2008 period hit, but over time, interest rates have dropped for the most part. And you can see that blue line descending all the way to 2022, where rates have started to rise again. As you can see here, although they're still pretty low by historic standards. That's the very far right-hand side of the page. But now look at the red. So this is the US government's interest cost as a percentage of all its tax revenues. And so to the left, very high, about around 17, 18, 19%. Which is really, really, anyone with a big loan knows it's financially stifling to not be able to have the huge interest payments to make. But then that came down really, really nicely all the way till about 2016, give or take, because rates dropped. I mean, so it was really simple. So the part that should be a little bit concerning is look at the right now. Interest costs are back almost to or around their all-time high as a percentage of our tax revenue, yet interest rates aren't that high. So the two things that happen, one is, what if rates go up some more? So that could be devastating. Two, because the reason that's happening is because we just keep adding more and more debt on. So another $2 to $2.2 trillion in new debt this year. What do you think that's going to do to the interest costs? It's going to make it rise, of course. So the point being that this is something that feels like it could break. And if it does, that could also be a source of issues. So I bring all this up to say that there are things happening out there. I'm going to skip this one if you don't mind. And there's things happening out there that give us pause. And we're long-term investors. We're not making short-term forecasts. You saw the asset mix before, still heavily equity oriented. But we think it's prudent to be diversified, to own non-US stocks, to own some value stocks, to own some small cap stocks, to own things that are actually very, very attractively priced. There's plenty of that out there right now. There's plenty of opportunity for those who want to look. And that's the key point for the future. So we're willing to tolerate, I hope you are too, a little bit of underperformance in a big up market. And then what we're looking to do, though, is to preserve capital in a down market. And more importantly, not wake up 10 years from now and need to have earned 8% to preserve the power of this capital, but instead to have earned at least that 8% we need, and not 3 or 4, which is what we think the S&P is going to do over the next 10 years. So stick to the strategy. Use the scale and stability and the time horizon. So this foundation has a long record of success. We're just going to keep basically doing the same thing, although the game changes all the time, as you know. And we will accept some volatility. That's not scary for us. We just don't want to accept it in exchange for poor returns. And that's what we fear for some of the AI type names today. So I will stop and hand it over. I'm not sure I'm handing it right to Larry or back to Dan, but whoever I'm handing to, I'm handing it.
Yeah, the Roanoke show. Let's hear from Lawrence, and then we'll hold 15 or 20 minutes at the end of the call for a Q&A more broadly. So, Lawrence, Lawrence and Mike Miller, no relation.
Very good. Thank you, Mike. Intimidating perspective. And I'm not sure I'm going to be a whole lot cheerier, frankly, about our local scene. So mission investing at VCF, we consider mission investing a subset of impact investing. This is where we're doing activities that are fully aligned with the purpose of the community foundation. Historically, Mike and his colleagues throughout this for all community foundations create the income necessary for grant making in addition to donations. And back in 2001, VCF made the decision to allocate 5% to investing directly in Vermont, and has been a leader in that nationally and continues to be. That 5% allocation we call the Vermont pool, and then we have some other assets that are outside of the pool that are also for Vermont investments, so we call the whole thing the Vermont portfolio. Our mission investments are intended to be well aligned with our grant-making impact areas. And our financial return goal for this part of the portfolio is to maintain purchasing power net of losses, expenses, and inflation. And so over the long run, that's been about 2.6%. So I think Mike's slide showed the core around 7.5. So we're essentially spending about 5 percentage points in financial return overall to invest for impact in Vermont. We don't have a particular rubric. We adjust. The committee makes a judgment on each investment about what a suitable return is, balancing a market rate risk-adjusted return for social impact. And then just a note on valuation. This is very boring from an analyst's perspective. These are long-term holds, very illiquid, no real market data. So there's not a lot of fluctuation in our valuations. We carry things at cost, net of interest and dividends, unless there's some real third-party reason to make an adjustment. So for that reason, we don't have a lot of quarterly variation in the value of this portfolio. If you pull down the slide deck from the website, I've got some background materials in here that may be helpful. But generally, these are the impact areas that we're focused on over this planning cycle. Education and training, climate and the environment, democracy, trust and community leadership, health and well-being, and economic equity. And the economic equity area does a lot of the lifting in this part of the portfolio in terms of where we're focused. You'll see home ownership and affordable housing in here, and I'll talk a little bit more about that as a concentration area later in the discussion. So Vermont pool and non-pool graphically, growth over time, and a blend of how we approach things. Fixed income means we're loaning money. Venture capital doesn't really mean venture capital in the way that we think about it at scale. There's some real venture capital in there, but it generally means we've got an outside manager who's doing interesting things. So I keep the list of current investments in the deck for you, and I know this is hard to read on the screen, but if you download the deck, you'll be able to blow it up a little bit. So equity, we do have some direct equity investments. In some cases, these were conversions of convertible debt. They tend to be very high touch, active pieces, and generally doing pretty well. This is a case where they have business activities that are really well aligned with what we're doing. In our fixed income, we are loaning money, and tends to be a mix of long haul and project acceleration loans or bridge financing to help somebody get through something urgent. I'll note we've been fielding a lot of inquiries from nonprofits looking for bridge loans around interrupted grant flows at the federal level. And there we're really having to be very careful and work with them about the question of whether it's a bridge loan or simply a pier out to deeper water, and having to understand, is the grant really just interrupted and going to resume, or has it been terminated? And there's a lot of those conversations that are pretty challenging at the moment. Recent activity, got a few different things that we're engaged with in conversations right now. The Evernorth project at the Weybridge Street Apartments is an interesting case in point, that sort of an example case. This was a property that was naturally occurring affordable housing. That is, it was relatively low cost when they acquired it in 2001. And because interest rates were so low at the time, they had a 2.5% commercial mortgage on this property. So it was very easy to maintain low rents. And this is 30 some odd units of affordable housing right in the walking area of Middlebury. Well, that's a 5-year adjustable note. So it's repricing now. And if it reprices at current interest rates, those units will not be able to remain affordable. So we're in conversations with the Treasurer's Office of LIAC money through VHFA, Evernorth's own resources, and us to put together a package that will keep this affordable through the next 7 or so years until it's ready for refurbishment and to enter into a low-income housing tax credit transaction to make it permanently affordable with capital A affordability. The Salisbury Square project in Randolph, this is conversion of the old Ethan Allen facility there to housing. This has been a long, long project. Watched this for many years. And our participation there, it's leasing up now. People are moving in right now. And we're helping with some bridge funding for grant anticipation that's coming in, and they had some challenges in timing and it absolutely needed to hit an occupancy date now in order to earn the tax credits for the project. We're engaged with the Caledonia Food Co-op. This is in St. Johnsbury. This is the reuse of the old Walgreens pharmacy, just on the edge of what has been the downtown. Well, so it'll expand the downtown a little bit. It's just a block down from the Railroad Street project that we invested in St. Johnsbury. They've got a lot of community activity. This is another one that's gone on for a while. They bought the property a few years ago and are doing the construction now. The trades program at the local school, high school, is doing some of the interior work. And so it's got a really neat combination of cost savings and education opportunities in there. So we expect that'll open in July. That in that case, we're doing a pledge anticipation loan. So they've got some 5-year pledges from members, and you can't borrow from a bank for that. I would say the biggest area, though, that we've been having conversations around are housing discussions. And this has really been, I think, as everybody knows, a very challenging issue for Vermont. Housing costs have risen faster than wages. So that's one factor, but construction costs have risen even faster. So housing construction is more expensive than the market value when it's built. And this has been just a very tough cycle. If you add in then the share of housing expense that has sort of crept up for Vermonters, and then you look at health insurance expense that had been capped at about 8.5% for most working Vermonters who have to buy directly on the exchange, and now the less of those premiums. We're seeing a lot of potential pressure in those households. And here I'm thinking specifically of the sort of what we refer to as the missing middle market. We've got a very strong capital A affordable housing program in Vermont. That is where the subsidies are flowing in. There can be non-dilutive grant funding, that sort of thing. So there's ways to work around the initial costs, not gracefully, but possible. And we see that cash purchases of vacation homes is certainly robust, but it's that workforce housing in the middle that's really challenging. So there's been a lot of conversations about that. I'd say there's been a great degree of progress. We saw in public policy, we saw the CHIP program passed. We'll see what the rules around that look like. That's a simplified tax increment financing scheme that'll pick up the infrastructure cost for communities for new housing. We're seeing a lot of opportunity there, but it's not going to be a silver bullet. These communities are going to need a lot of support to understand how it works and also how to be ready for a CHIP application. So those are involving a lot of conversations with the League of Cities and Towns and the Treasurer's Office again, and the Department of Housing. And this is where our role is in mission investing is sometimes financial and sometimes part of being a voice for what we see as the challenges, and working in collaboration with with a lot of our partners. I should follow on to Mike's comments. We've also been having a number of conversations about AI and the implication for rural communities. When we think about the nature of cities and what cities and urban environments have done for economic development and the hollowing out of rural, there's some interesting twists around AI and what that might mean for rural enterprises, what resources it might supply that aren't otherwise available easily. But AI literacy is one of those things that comes up just as we had experienced not very long ago. People didn't see the internet as relevant to their lives. And if you fall behind with this kind of evolution, it can be very hard to catch up. So how businesses and organizations adopt AI, learn how to use it, and continue to practice is incredibly important for community and economic development. So we've been having some interesting conversations about what that might look like. And then finally, I wanted to talk about one of our recent commitments, which is Northern Forest Fund 2. Try to talk about bring one up a little bit each meeting. The Northern Forest Center is a regional innovation investment partner that's focusing on rural towns. They realize that housing is a critical part across the entire rural market. So these folks work from northern New York up through Maine, are very active in Vermont. As they phrase it, rural communities in the northern forest face a growing crisis, too few homes for local workers, aging infrastructure, and mounting climate threats are undermining community vitality and economic resilience. Without quality housing, community assets, towns that struggle to attract and retain the talent they need, strategic investment is urgently needed. So their approach is to act as a nonprofit developer and midterm owner of housing and mixed-use projects. So, think of the 10, 15-year time frame. So build it, stabilize it, let it appreciate, and then it's ready to move. As a forest fund, they're interested in wood housing, and they're doing some really neat work in how to reduce the cost of housing in these projects, not just the subsidy, but how to address the cost. Mass timber and repeatable construction techniques are really some neat projects. So this is a $20 million fund. We're working in a 7-year loan at 3%, and we allocated $500,000. With all of these that are interstate, we have a little side letter that focuses on Vermont activity. This is an example of one where DAF holders can participate through a mission investment fund. We've got a couple of people who are doing that. And sort of what do we expect and why would we do this? We were a participant in Northern Forest Fund 1 specifically for the Railroad Street project. But across all of Fund 1, they developed 84 middle market homes and 5 commercial and community spaces in 7 focused communities. They proved that they can deploy the capital quickly. They proved that they can get a lot of other capital into these projects. They proved that they can get the money back to investors, that their thesis about who is looking for these properties is accurate, and just really gave us a lot of confidence through our participation in one project and focus on that they can do a lot more. So that's why we stepped up to Fund 2. Gotta figure out how to stop my share here. And I think now we're on to questions and discussion.
Excellent. Thank you, Lawrence. Just a couple of quick observation. I dropped in the chat for those who are interested in taking a little more time with some information about the Vermont Pool, our 2025 Mission Investment Portfolio Report. So you can take a look at that link at your own timeline, but follow up with any questions. Three notes, I would just have, and then open it up. One, to bring home the Northern Forest Fund partnership, last spring we were at the ribbon cutting for a new building in St. Johnsbury, missing middle rental homes. And some of the first tenants moving into that building that's walking distance to downtown St. Johnsbury, right there on Route 5. Were people who'd been flooded out of their longtime family home in Lindenville. The artist in residence in the studio space was somebody who'd partnered with the VCF, as the beneficiary of a grant from the Vermont Arts Endowment. So there is this sort of integrated capital approach to downtown community vitality that arises from a key partner like the Northern Forest Fund. When you see different types of philanthropic capital showing up in place in the experience of those who live in those places. And that, I think, is a really important thing for our fund holders to hold in mind. Not only are your funds invested in a really robust and comprehensive strategy that the team at Crucial manages, but a piece of every charitable fund at the Community Foundation is actually actively invested in these activities, sending a message to community that is one of hope, potential, opportunity, and all those things. And there are some conditions in Vermont that really lend themselves that are so complicated or of such scale that the best way for philanthropic capital to go to work on them is through an investment rather than a grant. And our ability to be nimble and adapt to those conditions and those needs is a really key piece of our impact as it grows. We have built out ways for fund holders who want to participate at a greater level in the mission investment portfolio to do so. So you can reach out to Stacy and her team for more information on those opportunities as they arise. But then with that said, I'll open it up for questions either for Mike, for Lawrence, for me and the VCF team. And I welcome it. Any questions out there? I see. I can also just keep riffing if that's welcome too. Tim Briglin just came off mute. Tim is the chair of our investment committee and a member of our board of directors. So thank you, Tim.
Yeah, no, it's good to be here. And I have a question for Lawrence. I see Mike Miller quarterly, and Lawrence, I'm not sure if you're going to be at our investment committee meeting in December. Can you speak a little bit about what the scale of opportunity is for the impact investing that you are doing? I know one of the things that VCF is focused on in the coming years is expanding the pool of assets that can be invested directly in this impact investing fund. And are you seeing more demand out there, or a demand that over the next 2 or 3 years could increase 50% to 100%, with the expectation that the assets under management in this impact investing portfolio are going to increase? What are the opportunities out there?
Yeah, I would say I'm seeing a lot of places where we could be participating, where we don't have the capacity to do so. We're really focusing on where we make the biggest difference, a unique role when we participate. And the need for that is both the need and the awareness are getting greater. For a couple of years, we were really working very carefully around deploying into some of these Vermont-based funds that were getting established and matching some of the SSBCI money, because that was a need to be able to get those programs to work, and to get it's a little bit of a barbell in the Vermont portfolio. We've got things like Features Capital and the VCF at Hula that we expect venture-like returns to come from. And we have some other things like 1% loans for affordable housing projects that are essentially a programmatic loss. And so we need those to blend at about 2.5. And we spent a little while on the higher return side the last couple of years, leavening that. So I think we're ready to do a little bit more on the higher impact over the next couple of years. I think housing is one of the largest areas of demand that I'm seeing. We're spending some time really thinking about the strategies that are appropriate. It's such a huge problem, right? Our decimal point against the housing problem in Vermont is not we don't have a lot of leverage. So we need to be careful about creating really efficient strategies. But this example of the Weybridge Street Apartments, where it's preserving naturally affordable housing, and we're in there for 5 to 7 years, that's a great example of the opportunities that are out there. We could easily double the flow without any insignificant increase in either workload or trying to source deals.
Al Carr, question? Can you hear me all right?
Yes, sir.
Okay, I'm representing Hannah's House. I wonder if you could elaborate a little bit more on the private equity. Who do you use? I mean, Blackstone, Blue Owl, the kind of the type of investment. Is it venture? Is it private lending? And is this an area where you're going to put more money into or take money out of? Thanks.
Oh, great question, Alvin. I think that's for me. So it's doesn't tend to be the big brand names, Alvin, to be clear. It tends to be smaller firms. For example, by far the best manager in the portfolio is a firm called Consonance Capital. Consonance is a mid-market healthcare buyout manager based in New York, that's been around for 12, 13 years. Their first fund, which the foundation was invested in, has been a 9x, just to be clear how successful and successful distributed. So it's firms like that. There are some other names that are also, but they tend to be what we think are the leading names with smaller capital bases. The portfolio tends to bridge venture, growth equity, and buyouts. We don't do really any private lending, private debt. Very concerned with how that business is structured these days. So we tend to avoid it and have for a long time. And last but not least, to your question, I don't want to speak for the committee, and so I would hope that some of those who are on the call will correct me if I say this wrong. But I would argue that private equity will get smaller over time, in part because of the desire to control fees, which is a very, very wise thing to do. But that doesn't mean zero. So I think, for example, it'd be a very interesting test for the committee. Consonance is, for example, coming back this year, and someone's going to do 5, 7, 9x funds. Might be one that the committee wants to keep committing to despite the fees. But the average, let's get 1.5x and a 9% IRR and pay a lot of fees for, I think is ancient history. So my expectation is that the portfolio's private piece will get smaller.
Okay.
Here you go.
Yeah,
Boom.
thanks. No, that's a good answer. And I kind of like what you've done and the direction you're going. So many thanks.
Thank you.
Other questions out there? I think if there's not a question, I'll add just a note of clarification. Lawrence referenced the SSBCI program, which may not be familiar to a number of folks on the call, but it was a U.S. Treasury program that was part of the recovery legislation post-pandemic, intended to seed startup and venture and entrepreneurial activity across the country. In many cases, the funds which benefited from those and were able to draw down those and selected to draw down those investment dollars needed to have a local investment matching partner. So as with the case of Features Capital, which is a health tech and venture platform based here in Vermont, the VCF acted as a key piece of that local match in order to bring resources to bear that or then able to deploy in the entrepreneurial and startup environment across the state. That opportunity for leverage is something that Lawrence and our team look really hard for across the scope of investment opportunities in the Vermont portfolio. Other questions? Fewer questions when the news is as good as it's been. Well, we're coming up on our time. If there are light bulbs that go off, I know there's a lot of longtime partners, a lot of thoughtful people on the call. If there are light bulbs that go off and questions that you want to follow up on, reach out to the team here at the VCF. And we're happy to answer them or do our best to do so and bring in the expertise from Mike if it's at that level. I want to thank those involved in our governance and the stewardship that's been of these resources, members of the investment committee and the members of our board who are on the call. Organizing that and really beefing up our governance approach over the last few years has been a really key priority of the board. And I think it bears out in this pool consolidation effort that really was intended to achieve three things. Simplify our administration of multiple funds across a lot of different managers, drive down fees, and improve our visibility into the environmental, social, and governance implications of the investment portfolio. And we're excited about where it landed and where it's going to head. As we look out again, I'll end where I sort of started. And as we look out in the giving season towards the end of the year, there's a lot of turbulence in the world. One of the things that we stitch together in the course of philanthropy is this sense of community and the sense of our role in supporting our neighbors who are affected by that turbulence. That work is important. It's going to be important this year. It's going to be important next year. It's going to be important long into the future. And that's why we are incredibly grateful to you all as partners of the Vermont Community Foundation for the work we get to do together. So thank you for taking the time this morning for the update. I look forward to hearing from each of you any questions that arise and touching base in the coming months. We'll see you again in Q1 for the next public call. So.
Bye, everyone.
Thanks,
Nice to
everybody.
see everybody.
Have a great day. Thank you for joining.
Thank you.